Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're talking with a veteran of the small cap sector, an exceptionally interesting one right now for reasons we'll get into in a second. But first, let me introduce him to you. Eric Green, CFA, is Chief Investment Officer, Senior Portfolio Manager, and Senior Managing Partner of Penn Capital. Prior to joining Penn Capital, Eric was with the Federal National Mortgage Association, some of you know as Fannie Mae, Royal Bank of Scotland, and the U.S. Securities Exchange Commission, where he served as a financial analyst in the Division of Investment Management. He is a vice chairman of the board of directors of the Anti-Defamation League. He received his BSBA cum laude from American University and an MBA from the Yale School of Management. So welcome to the podcast, Eric.
Thank you, Rob.
So I'd like to start at the top level. Which macro factors are making small cap valuations and the possible future returns more interesting now, in your view?
Sure. There are multiple factors that we believe make small caps very attractive and particularly timely right now. You have valuations that are historic lows versus large cap stocks. You also have, we had a period where large cap earnings were growing faster than small cap earnings, which is pretty unusual. That was driven by the Magnificent Seven.
Right.
And they were growing very fast. The law of large numbers says that they won't grow as fast going forward. Now small caps can catch up. There will be an inflection where small cap earnings will grow faster than large cap earnings. We have an M&A cycle picking up right now. We're seeing that in our portfolios. We're seeing that across the board. And the credit market is extremely accommodative right now with spreads near their lows all the way back to for the last 15 years.
Right. That's a good point. And I should have clarified in my introduction, we're talking about small cap equity and fixed.
Yep.
Yeah, because it's you're one of the rare folks who actually focuses on both of them. Let's drill down into that a little bit. So the obviousness of what's going on with the earnings between the small cap and large caps, and a lot of people are well aware of this. Many of the large caps have earning expectations for the next 4 quarters that they couldn't make if they were going gangbusters, right? It's impossible. So that's going to happen. It's just a question of when, right? You know, some of the other things we talked about, I'm interested in what you see in the M&A impact on the subsector.
Sure. We went through a couple of years where M&A barely existed. Now we are seeing deals in our portfolio. We had more deals in the last 2 weeks than we had in the last 2 years. We're invested in a few of the investment banks that do M&A deals, and their pipelines are extremely strong. There's been a backlog of deals that didn't get done over the last few years that have lined up to get done over the next few years. Private equity has a lot of cash on the sideline. And something very important, confidence is up from the acquirer, from the private equity firms. The Fed is cutting rates, or if rates stay the same, whereas a year ago, the Fed was raising rates, and a lot of the borrowings for deals are done in the floating rate market. And the companies that were doing the deals really weren't sure where their cost of capital would be over the next throughout the duration, and they couldn't figure out what their IRR could be. Now, rates are either going to go lower or they're going to stay around the same, and they don't have to worry about their cost of capital going up considerably through the duration of the acquisition.
Right. I mean, I would gather that's the inflection point, right? They can structure the deal around the current rate and have a high level of confidence about it now.
Yes.
And then worry about the rest of the due diligence stuff they have to. But
not to mention that the confidence in the economy with the Fed cutting rates and the economy not being in bad shape right now has increased pretty significantly over the last 6 to 9 months. And certainly there's more confidence as the Fed continues to cut rates back to more normalized levels.
Right. So let's dig into a little bit into the optimism about the economy. I mean, it's also in the newspaper a lot, so I don't want to roll over things that people are reading a lot. But from a growth perspective, things are okay. What do you see on the sort of one level down from there? Is there regional strength? Are you all playing anything, seeing anything interesting on a regional level, or other stability on a subsector level?
We're seeing strength and future strength out there, particularly on the manufacturing side, where there are projects that go all the way back to early Biden administration that are just starting to come out there. So there's been the manufacturing index has been negative for a while.
Yes.
We see that turning positive. And just generally, the Fed cutting rates, the consumer is going to feel better in a lot of places where they're borrowing money.
Uh-huh.
The with the Treasury, which has not reacted the same way as the Fed cutting rates, actually gone the other way. Treasury rates are up. That's going to hurt housing and is a bit of a negative. But usually, when we're cutting rates, we're cutting them into a really bad recession or a bad economy.
Right.
Now we're cutting rates into a decent economy, and it's likely to make that even better.
Yeah, that is fascinating. And the long rate bounces around a little, you know,
Yes.
but
Yeah.
it doesn't move that far outside of the range, right?
Yeah.
I realize that's a short-term thing that is a little tricky, and it's not the only factor that's pinching housing, right? Just the cost of housing
Sure.
overall is a multifaceted thing.
Yes.
That's wouldn't change necessarily even if rates dropped by 50 bips overnight.
Yeah, I agree with that.
There's a lot of things that are causing housing to be expensive. But let's keep with the well, on the financial assets. As this is a event, this is a podcast for CFAs. There's been a lot of talk. You mentioned private equity before.
Yes.
Flush with money. Exceptionally optimistic noises coming out of that side of the market right now. There did pop up a little bit of a discussion from an asset allocation perspective about the relationship between private equity and small cap. And we talked about this a little bit in our call when I prepped for this. So you have an interesting perspective on that. How do you view interoperability of those things, if there is any?
Sure. Private equities are just general. They're private companies of levered small cap companies, essentially. And we buy small cap levered companies because we get a lot of our information from the credit markets, and we think that they're underfollowed and undervalued. So we run into a lot of similar type of companies. And in fact, a lot of our companies get bought by private equity as they clean up their capital structure, and then private equity relevers these companies. But what we're seeing today, I don't see a reason to own private equity and to own small cap. We see small cap being much more attractive today. Fees are obviously a lot less for small cap, but you don't have a lockup, and you have the opportunity to get into this asset class when it's very cheap. One of the things that has struck me recently, the last few years, is that private equity, because of all the money that's been poured in there and everybody looking for deals, and this also goes to private credit, by the way, uh, that the deals are getting done at prices that are higher than the public market, at
Right.
multiples that are higher. So one private equity firm sells a company to another private equity firm. It's being done at multiples that are higher than the public market. And what that says to me is that there's tons of value in the public market. Also, these private equity firms need to get these higher prices so they don't have to mark down their portfolios.
Right, which they can't do because there's a knock-on effect with all their investors who had marked
Right.
it somewhere. Yeah, that does make it tricky. One thing that you just said that I thought was exceptionally interesting, and I'm a tiny bit biased here because I used to work at a bond rating agency, but I do think that bond underwriting matters. You all seem to kind of come at the equity side of your investments from a credit assessment perspective. Could you talk a little bit about that?
Sure. It's about 400 or 500 companies in the Russell 2000, the small cap benchmark, that have leverage greater than three times, and about 300 companies with leverage greater than four times. We hunt in that universe where most of our peers don't like to buy companies that have leverage outstanding, because we believe we're experts on the credit side and we really understand credit. We think that we can buy companies like that. We've never had a bankruptcy in the 27 years I've been at Penn Capital in our
Cool.
portfolio.
Yeah.
But we're following the price of the bonds and seeing if the credit market is giving the company a stamp of approval and the stock really isn't working. That's an opportunity for us. We're looking for a company who's improving its capital structure, paying down debt. There's a transference of value from the debt holder to the equity holder. And then as a company delevers, more and more of my peers and investors will be interested in that stock as that capital structure improves. So we're looking for companies to go from a capital structure that investors are not comfortable with to a capital structure that they're comfortable with. And as they're doing that, they're deleveraging, and their multiple should expand as more of my peers buy those companies.
Right. This is a perfectly understandable. Don't hear too many people do it because it's a massive amount of due diligence. Right.
You know what? We actually don't feel that way. We feel like if I'm going to look at an equity, I need to be an expert in the capital structure. I need to understand the balance sheet. When I tell people and they say, how can you do bonds and stocks? I say 95% of the work are fundamentals that you have to do on the bond and the stock anyway. So where was the company? Where is it now? Where is it going forward? The last 5% is just math. Is this company trading attractive relative to its peers on an enterprise value to EBITDA or free cash flow basis? the way we look at it, or on a spread basis on the bond side. Is this cheap on a spread basis versus its peers based on its fundamentals? So we actually feel like I wouldn't even know how to look at a company without looking at the whole capital structure. All of our analysts are required when they write up a company, a new idea, to evaluate the capital structure and tell me what could happen in that capital structure to improve the value of the equity, or actually a risk in that capital structure that could hurt the value of the equity.
Yeah, and this is critical in the area that you're in, right?
Yeah.
Because there's a lot of volatility in there.
Yes.
At certain times, there can be a massive
Yes.
amount of volatility.
One point I also would like to make here is, if you are interested in investing in small cap stocks, you should be invested in a manager that buys small cap stocks. And what's happened over the last 5 to 10 years is that some small cap managers have gotten very, very large. Their average market cap, we looked at this the other day, the average market cap in the Morningstar small cap mutual fund benchmark is over $5 billion. So the average manager is buying $5 billion plus companies,
Right.
when the Russell is closer to 2 billion.
Right.
So if large beats small, you want to be at larger small caps. But if small beats large, you want to be in the smallest of the small caps. So it's something that when you're considering using a small cap manager, you should also consider, are they really a true small cap manager? And some of them have gotten so big they can't help it. They own the whole market and they have to buy the much higher market cap companies. But what's amazing is about 75% of the Russell 2000 has market caps below 2 billion. And most managers aren't looking there.
Right. Well, that's always been the case, right? There's always been this general trend of small cap managers towards I hesitate to use the word SMID.
Yes,
right.
Sure.
So,
and mid now.
Yeah, and that's actually 5 is mid. Yes. Yep. Okay. Well, let's go into subsectors then, because I want to. It's interesting to establish your focus on the capital structure, your focus on the capital flows. Let's talk about which subsectors of small cap you all are most focused on now and why.
Sure. We want to be in cyclical sectors. First, that's a pretty good match with the high yield universe. It tends to be pretty cyclical. With an economy that, as we described earlier, that's good, that likely is getting better with the rate cuts going forward, you want to be in companies that are short duration companies that will grow very quickly in a cyclical recovery. So cyclical areas in the market are materials and industrials, energy, consumer discretionary, technology in certain areas, semiconductors are cyclical. Whereas real defensive areas of the market, they actually had a really strong third quarter, particularly in July when rates were coming down. The defensive areas like utilities and REITs and some healthcare, those are areas we are not overweight. We're underweight those areas and want to be more overweight cyclical areas of the market.
Yeah, because taking REITs for example, it's been it's a tough one for now 2 years, right?
REITs we're less underweight REITs. We think that there's some opportunity there because valuations have come down a lot, and with an improving economic environment, it makes the real estate assets more attractive and improve in value. But we're more in specialty REITs and ones that are pretty much out of favor, as we're not in the traditional type of REITs that people think about.
Yeah. I mean, this is exceptionally interesting because, we're going to launch in December a series of podcasts on the commercial real estate market. And we're going to focus them surprisingly partially on the office market, but also on the other subsectors, some of which are doing exceptionally well.
Yes.
So it's one of those things. Well, thank you, Eric. This has been an exceptionally
thank you. I enjoyed it.
Interesting conversation and also an interesting time for small cap. So, and thank you to everyone, members who listen to this podcast. If you would like to hear more from our podcast, you can find us on any of the podcast apps. If you're just listening, this is on our website. Please check one of those out. And if you're looking for an event to attend here at CFA Society New York in the near future, and you're interested in some of these kinds of niche sectors, we do have the 10th Annual Veterans and Transition Symposium coming up on November 6th at 6 p.m. here at CFA Society New York. If you want to help out a vet, some of these folks have exceptionally interesting backgrounds in quant that make them exceptionally interesting folks to consider hiring. So please attend that event if you're thinking about it. Until next time, I'm Rob Rowan, and this has been Compound Insights.